We are officially in the planning phase of summer. While everyone else is looking at Expedia for the best flight deals, as a business owner or a side hustler, you should be looking at the Internal Revenue Code. Most people think business travel means a boring Marriott in Omaha for a Tuesday conference. But in 2026, the Bleisure trend is one of the most powerful tax optimization strategies available. Today, I'm going to show you the exact framework to turn your family vacations into legitimate business deductions. So, if you want to travel for free this summer without triggering an audit, let's dive in. First, let's see if you even qualify. If you are an LLC, corporation, or partnership, no surprise. You are covered as long as that business is actually active and seeking profit. If you are strictly a W 2 employee, I have some bad news. Ever since the tax law changed a few years back, the IRS doesn't allow you to deduct unreimbursed work travel on your personal return anymore. However, if you have a side hustle, even if it's just you and a laptop with no LLC yet, you are in the game. The IRS doesn't care if you're incorporated. They care that you are carrying on a trade or business. Schedule C in your tax return is exactly where these Bleisure deductions live. Okay, now we have to talk about the primary purpose test. For domestic travel within the US, the IRS looks at your trip as an all or nothing deal for the transportation costs. The rule? If more than 50% of your days are business related, the trip is primarily for business. Let me give you an example. Let's say you fly from Seattle to Miami. The flight is $800. Scenario A. Let's say you're heading to a mastermind, which is basically a high level business intensive with other entrepreneurs. You spend 3 days in a conference room in Miami dissecting your business's cash flow. Even if you stay Friday and Saturday to hit the beach, those first 3 days of mastermind work prove that the primary purpose of the $800 flight was business. So the 100% of $800 is covered. Scenario B. You spend 2 days at the mastermind and 3 days at the pool. Now the trip is primarily personal. You can still deduct the 2 days of hotel and meals, but that $800 flight, zero deduction. Here's my pro tip. Masterminds are often expensive to join, anywhere from $5,000 to $50,000 plus a year. Because the membership is a business expense, the travel to reach the required meetings for that membership is also a business expense. Remember, a real mastermind has a schedule, a list of attendees, and specific business goals. If they have those, they have a solid defense in an audit. And here's the secret sauce of travel deductions. It's called the weekend standby rule. The rule: if you have a business reason to be in a location on a Friday and a business reason to be there on the following Monday, the intervening Saturday and Sunday are considered business days. Imagine you have a client meeting in San Diego on Friday afternoon. You have another meeting with a different vendor on Monday morning. Because it is cheaper or more reasonable for the business to keep you there over the weekend than to fly you home to Seattle and back again, the IRS allows you to deduct your hotel and 50% of your meals for Saturday and Sunday. Essentially, the IRS just subsidized your weekend getaway because you sandwiched it between business obligations. Now, if you're planning a trip to London, Tokyo, or Cabo, the rules change. The IRS is much more skeptical of international business trips. Outside the US, you must allocate your transportation costs or the flight proportionally between business and personal days, unless you meet one of two exceptions. Number one, the 7-day rule. You are outside the US for 7 consecutive days or less. Number two, the 25% rule. You spend less than 25% of your total time on personal activities. Let's say you are flying to London for 6 days. 4 days are for a professional conference. 2 days are for sightseeing. Since you spent more than 25% of your time on personal stuff, even though you were gone for only 6 days, you can only deduct 33% of your airfare. However, if you had spent 5 days of work and 1 day of play, you could have deducted 100% of the flight. Now, here's one of the most asked questions. Can I deduct my spouse? Unfortunately, the answer is usually no. Unless your spouse is a bona fide employee of your company and has a substantial business function on the trip, you cannot deduct their airfare or their meals. However, you can deduct the full cost of your lodging if the price of the room is the same, whether you are alone or with your family. If a king room is $300 per night for one person and $300 per night for two, you deduct the full $300. If you drive your own car or a rental, the cost is the same whether the car is empty or full of kids. You deduct the full rental hash mileage. If you are a content creator and your spouse helps you film or manages your account during the trip, you might have a case, but you better have an employment contract and a payroll record to back it up. In a recent 2026 tax court case, a taxpayer lost thousands in deductions simply because their records were reconstructed after the fact. So, keep your boarding passes. Take a photo of the conference program. Save a calendar invite for every meeting. Use an app like Expensify or QuickBooks Online to snap receipts in the moment. If you can't prove why you were there and who you met with, the IRS will reclassify that business trip as a non-deductible personal vacation and hit you with a 20% accuracy-related penalty. Before we wrap up, I have a quick bonus tip for those who are thinking to or actively working to start a business. If you are in that preparation phase, costs incurred before the day the active trade or business begins are considered Section 195 startup costs. This includes travel to scout locations, attend training, or meet potential vendors. In the year the business finally goes live, the taxpayer can deduct up to $5,000 of these accumulated startup costs immediately. Anything beyond that must be amortized or spread out over 15 years. If they travel in June to scout a location but don't open their doors or start selling until January of next year, they can't claim a single penny on this year's tax return. They have to wait and claim it as a startup cost on next year's return. Tax planning isn't about hiding money. It's about following the rules that the IRS laid out to encourage business growth. If you're traveling anyway, you might as well do it in a way that builds your business and protects your cash flow. If this helped you plan your summer, hit the like button and subscribe for more tax-efficient wealth strategies. Thank you for watching.